Welcome to this Bennett Explains finance video. This week, how bad news for the banks could be good for you. Now, there is a lot of bad news out there. Let's just give you three examples. Investment banks just had their worst quarter since the financial crisis, Fortune magazine recently. Barclays' profit slumps on investment bank hit. That was Market Watch. And Europe's investment banking pain is here to stay, the Wall Street Journal. And that's just three. I could find you plenty more. So, the question is, what's going wrong and how can you turn that potentially to your advantage as a contrarian investor? Now, first of all, who are we talking about? Well, a global bank could be made up of two sides, but it's the investment banking side that's getting all the headlines, or the wrong headlines if you like. Just a reminder, if you do operate retail banking, some do, some don't, that's the bit I'm not really talking about here. Savings accounts, debit and credit cards, mortgages and personal loans. What I'm focusing on is the bit on the right-hand side. Usually in a bull market, the sort of sexier, riskier, higher fee stuff, if you like. Fundraising, it's helping companies coming to the market for the first time, helping governments to raise money. Deal underwriting, putting a floor under a new issue to make sure it doesn't go too wrong and the issuer raises the funds they want. Mergers and acquisitions, more or less what it sounds like, advising companies, buying each other or merging. Market making and prop trading, that's the bank using its own capital to go into currency, commodities and bonds markets. And then asset management solutions, putting deals and products together for the asset management industry. And there's a sort of shopping list of their main activities. Now, why the shopping list? Because I want to identify a number of areas where it's all going wrong. Across the Big 12, more about them in a moment, revenue is down 25% in quarter one, and because of the way they operate, that's going to have a pretty traumatic effect on their bottom line profits, about which more in just a moment. So who are these people and what's going wrong for them? Now, who are they? Panel of 12 are often mentioned in the same breath, if you like. All the big names are in there, through from Bank of America, Citigroup, Deutsche Bank, Goldman Sachs, JP Morgan, Morgan Stanley. These are banks that are either primarily investment banks doing the stuff on the right, the previous slide, or have got big investment banking arms. Okay? Now, taking those together, what's happening? Number one, volatility is creating uncertainty, and that's affecting the behavior of both professional and retail investors this year. What's happening is plunging oil prices, China's economy, and low or negative interest rates are sort of combining to create uncertainty. And that means that if you are an organization, an investment bank, that makes money from trading equities and or fixed income bonds and or currencies and or commodities, some of the big things these banks trade, you are not making anything like as much money as you were a while back. But that's only problem number one. Problem number two is regulation. And they're being hit on two sides here. Number one, regulators are saying, we're a bit worried about you, we don't want another financial crisis, you need to hold more capital back, if you like, have a bigger safety buffer, reduce your risk-taking activities, and do less of one in particular, called market making. All right, so the banks are being pushed on one side by the regulator, and then they're being slapped with big fines on the other for things like the recent LIBOR rigging scandal. So regulation is pushing them back too. Then you've got the fact that where banks used to make deals happen and take money from them, from both predators and targets. All right, so you get a bank on the left advising a predator, someone looking to buy a company, on the timing, the funding, all the regulation around it and so on. And you might get another bank advising the target on how to defend themselves and so on. If companies are doing less of that activity, that means investment banks can't take a cut of it. And the same principle applies to new issues. Fewer new issues, fewer IPOs, fewer companies looking to raise money means that the banks who would traditionally look to advise on the timing, the regulation and so on, and also take a fee out for underwriting the whole thing, sort of guaranteeing it doesn't go too badly wrong, that's kind of drying up too. And if you combine all of those problems, and there are some more out there by the way, lower demand for structured products and so on, combine them all together and add in a business model that suffers high fixed costs, which these banks do, and you've got a problem potentially. Now, just to illustrate why, here's a very simple model, stripped down model, a sort of investment bank P&L if you like. Sales of 100, variable costs quite low, fixed costs quite high at 80, profit overall 10. 100 minus 10 minus 80. Now, in a good year, this is good news. Why? let's say sales rise 10%. This is not what's happened to the investment banks, quite the opposite, but if they do, your variable costs go up a little bit, your fixed costs don't change, and most of that increase in sales drops through to the bottom line for a handy 90% increase in profits. Just a 10% rise in sales. Happy days. But these are not happy days. And the problem with that model is, in reverse, the opposite happens. Imagine sales don't rise, they drop by only 10%. And I was talking about 25% back there. Your variable costs go down a little bit too. Your fixed costs don't change. There's a clue in the name, if you like. That's your staff costs and your buildings, for example. And therefore, your bottom line profit could drop from a healthy 10 to a much less healthy 1. Or a 10% drop in sales gives you a 90% drop in profits. Pretty bad news. And that's why the Telegraph has picked up that investment banks are laying people off, and there's more of that probably to come. Now, if you're thinking this guy is just full of gloom and doom, actually, as an investor, you need to stand back sometimes, not join the crowd, not join the uncertain folk, and actually think, hang on a minute, all these banks are being tarred with the same brush, so all their shares are being marked down, everybody's being talked about in the same bucket, and actually, love them or loathe them, as an investor sometimes you have to sort of take a slightly independent view. These are organisations packed with talent, innovation and creativity. So, is it likely all of them are getting it wrong, and is it likely all of them will get it wrong for the indefinite future? Probably not. So, the message from this video is that this is a classic case of stock pickers, a little bit brave, a little bit contrarian, doing a bit of homework, could see this year as a land of a little bit of opportunity. On that note, questions to the usual place, please.